So with the recent news of the Apple stock split being a 4-to-1 stock split and the Tesla stock split being a 5-to-1, I thought I'd quickly explain what exactly a stock split is and how it's actually going to affect you as an investor so that we can quickly go through this information and you can learn something new. So to start off, I want to mention that there are two types of stock splits that you need to be paying attention to. The first one is called a conventional stock split, and this is just the normal kind that we're seeing right now with Tesla and Apple. And then there's another type of stock split called a reverse stock split, and this is more uncommon, but it does happen. So I'm going to explain how both of these work so you guys can learn something new. Okay, so with a conventional stock split, the way that I want to explain it to you guys is kind of like a pizza. Think of a share of a company as an entire pizza. Now, what you're going to do is if the company decides that they want to do a stock split the conventional way, is that they are actually going to split that pie into more pieces. So for instance, Apple right now is going with a 4-to-1 stock split. So they're going to take that pizza that's a whole right now and they're going to split it into 4 new pieces. Now what this means is that if the share price is $100 and now you turn it into 4 new slices, then those shares are now going to be worth $25. So it actually looks better to the public because you can get into the stock a lot easier because it's only 25 rather than 100. And this is exactly how it works. Because right now, if you wanted to own 1 share of Tesla, you're going to be in it over $2,000. And that is a lot of money just to invest in one specific company. Because honestly, most of us out there, when we have a little bit of money to invest, it's probably going to be less than $500. So in this case, Tesla, they're doing a 5-to-1 stock split at the end of August in 2020 as I'm making this video. And because they're trading at over $2,000 a share, when they do this split, it's going to turn it into a 5-to-1, like I said, and now the shares are going to be $400 a piece, which is a lot more affordable as a perceived value, because we all know that $400 sounds a lot less than $2,000, even though the math is exactly the same. Now I'll go over how to do the math here in just a minute, but I do want to bring up a couple points here. And the first point that I want to mention is the fact that the perceived value, meaning the share price, does not necessarily mean that it's a good value. Okay, so for instance, if you guys wanted to buy a bag of Doritos and it was $10, we all know that that's a ripoff because we're used to them being about $2. But we all know that you're not going to break the bank if you do buy that bag of Doritos for $10. So it's the same way on the stock market. You don't want to just look at the price of a share and determine that that is a good value. So if you find a company that's only $5 a share versus $200 a share, that has nothing to do with whether or not it's a good value or a bad value. So just keep that in mind, because when there's a stock split, it does look a little bit better, but nothing changes on the back end. And then another point that I want to make is a lot of brokerages out there actually let you invest in what are called fractional shares nowadays. And what this means is that you don't have to buy whole shares of a company in order to invest with them. Because traditionally, if you wanted to invest in, let's say, Google, and they cost over $1,500 a share, then you're going to have at least $1,500 to invest in that specific company. But with fractional shares, you can start with as little as $1. So for instance, on Robinhood, I'm pretty sure they have $1 minimum to invest in fractional shares. And also M1 Finance, another brokerage, they have a $10 minimum investment. So this means that for as little as $1 on one brokerage and $10 on another brokerage, you can invest in a specific company, but you don't have to have that much money to start investing with them. So when it comes to stock splits don't really matter if that brokerage offers fractional shares, because obviously you can just get into the company with as little money as you want. Whereas with a normal brokerage account that doesn't allow you to do fractional shares, you would want something like a stock split so that you could actually afford to get into those specific companies. Now, as far as the math goes when it comes to a stock split, if you yourself already own shares of a company and they announce a stock split, nothing is going to happen to the value of your portfolio. You're just going to own more shares. And so I'm going to explain exactly how that works really quick so that you guys can make sense of it. So let's pretend that you own 10 shares of a company and that company's share price is $1,000 a piece. So in this case, you have a $10,000 investment in your portfolio. Now they announce a 5-to-1 stock split, and what this means for you is that your share price is now going to only be worth $200 a piece, but now you're going to own 50 shares, which is still $10,000. So it's exactly the same, you just own more shares, and that is exactly how it works, and that's all you have to worry about because it's really not going to affect you. It just looks a little bit different from an outside perspective. And then one thing that I am in favor of when it comes to stock splits is the fact that there's always going to be a lot of hype around that specific company whenever they announce the split. So for instance, there's going to be a lot of investors out there that want to pump more money into that company in hopes that when they have the split, they're going to own more shares. Even though, like I said, the math is exactly the same, but to them, it's a higher perceived value because now they own more shares of that company. Now, because that happens, generally the stock price is going to go up a little bit, and that can help you as an investor. And also in the future of the company going forward, I think that a stock split is a good idea when they can get those prices down. Because for instance, if it was $1,500 a piece and now it's only $400 a piece, and all those brokerages out there that don't allow fractional shares, this is a really good way for more investors to start investing in those specific companies, because I want more people to own that specific company that I'm invested in, because that means that the stock price is going to go up. So when it's only $400 versus $1,500, it's a lot easier to get in for most investors out there, because like I said, most of us probably just have about $500 or less whenever we have a little bit of extra money to invest in. Now, a reverse stock split is exactly the opposite as a conventional stock split that I was just talking about. So with a reverse stock split, what's going to happen is the shares are actually going to go down. So that means if you own 10 shares and they did a 2-for-1, then now you'd own 5 shares of that company, but the value of those shares would double. So the math is exactly the same, but now you have less shares of that specific company. Now, when it comes to a reverse stock split, the only reason why a company would want to be doing that is because their share prices were falling below the standard requirements of being on the stock market. So for instance, if you had a share price of only $2 and that wasn't meeting the requirements to stay on the market, then you would do a reverse stock split so that you could retire a bunch of shares, but you could get the share price to go back up to the level that met those requirements. So that's one of the reasons why a lot of companies decide to do a reverse split. So if a company was trading at only $5 per share and then the company announced a reverse stock split of 5-to-1, then what this would mean is that the share price would go up to $25 a piece, but there would be 5 times less shares on the market because those would need to be retired. Now in this case, it just is a perceived value. Once again, the stock price goes up, but nothing on the math end actually changed. So in this case, if you had 1,000 shares of that company that are worth $5 a piece, then you would have a $5,000 investment in your portfolio. Now with the reverse split being a 5-to-1, you're now only going to have 200 shares of that company, but they're going to be worth $25 a piece, which is still the $5,000 investment that you originally started with. So like I said earlier, the math is exactly the same with the reverse stock split, and it's also the same with the conventional stock split. You just have to look at it a different way. Now, if you guys are interested in investing, I do have an affiliate link for Webull in the description below, where they will actually give you 2 free stocks valued up to $1,400 just for signing up with them and depositing just $100. So if you're interested in 2 free shares, definitely check them out. Also, if you guys just found this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So consider subscribing if you're into this type of content, but thank you for watching and have a great day.